I've spent the last 20 years working in finance, 12 years working in financial planning. I've purchased dozens of properties for my clients that have grown 20, 30, 40% in capital growth in the space of 18 to 24 months. And this is one of the biggest issues that I find people make when it comes to building their property portfolio. Now, what I'm finding a lot of people do is they buy property that doesn't increase their serviceability. What I mean by this is they normally get to one or two properties, and I'll show you why in this projection tool. Let's say, for example, we're buying a property 1 January 2026, and the average rental yield that they're going to get is 3.5%. So 3.5% on a $600,000 property is around about $400. Now, we're going to borrow 80%, which means that we need to fund the remainder of the purchase price. So your deposit of 20% is 120, and then you're looking at roughly 30-ish, depending on what state you're buying in and a few other bits and pieces worth of legal land stamp duty. Let's call it 160 for fun. So 160,000, and then we're going to have property expenses of around about 11. We'll call it $12,000 just in case. Now this will be your council rates, it'll be your insurance premiums, it'll be water rates, it'll be any land tax, it'll be property management expenses, and any other budgeted incidentals or maintenance requirements for the property as well. And you can see here, assuming that expenses go up at 4%, we get capital growth of 6% year on year with it, which is just a very conservative, rough average. And then we get rental growth as well of 6%. Now, rental growth typically over the last 3 to 5 years has been up to 10% in some locations. Now, we've seen a lot of state governments hamper that rental growth because they've put protections in place for tenants so that they're not bombarded with rental hikes year after year or even within the same year. So in some states, they've capped the number of rental increases or the amount of rental increases in certain areas. And then so I've put together a conservative rental growth rate of 6% and then a loan interest rate of 6%, which is pretty average at interest only at the moment. So look, that being said, your property value over time will go up year on year by 6%. So you're looking at roughly after a 10-year period here, you're looking at $1 million in total in property value. Now we're paying interest only, so your loan will remain at $480,000, and your equity, which is the difference between your loan and the property value, is growing as well. So we've got a roughly $530,000 in equity, and the bank will let us borrow 80% of that. So the usable equity based on LVR is going to be $330,000. Now this is the mistake most people make. They get to about $200,000 here of equity, whether they pay it down or their property grows up in value more than that 6%. Lately, it's been pretty high if you're purchasing in higher capital growth areas. And they get to this point and the property is still hemorrhaging money. You can see here in the first year, it's costing you roughly $20,000 a year. And the property is still hemorrhaging money by that time because you haven't had great rental yield or great growth. And the argument is going to be, oh yeah, but I can depreciate it. There's depreciation schedules, and I can claim tax deduction on the loss that I'm making here. You're still losing $14,000, $15,000 or even $20,000 in the beginning to save yourself 30 cents on the dollar, maybe. So you're still losing money even after those tax savings. And yes, the property has grown in value, but you're very reliant on your income. So now you get to your second property. So even here, assuming that you hold it for 20 years, okay, that property is going to go from cash flow negative. It's not going to be parity until 2042, which is roughly 16 years, 17 years down the track. So in 2042, that property is finally going to be cash flow neutral or close to it. Hopefully it grows a little bit more than that. And then you'll end up with total equity to sell the property of 1.8 less your loan. And then you have 1.3 after that, excluding any sales costs, capital gains, marketing costs, all that sort of stuff. So ideally, to build your property portfolio, you need something that is going to give you greater rental return and it has greater rental yield. So say, for example, we buy another property. Again, we can't buy this property until at least, we're looking here at 2032. So in 2032, we buy another $600,000 property if there are $600,000 properties by then. And we buy something, it's returning $400 a week. Okay, now we have to borrow the deposit plus upfront costs. So your debt is going to be around about $650, okay? And your property expenses, we're going to assume the same. If you can find something of this price point in 7 years' time and in 2032, when you look to purchase, And then you can see there that your overall usable equity, if we go back to the chart, your overall usable equity is pretty much nil. So all the gain that you've had there, it's gone to relatively nothing. But your cash flow is down to negative $45,000 a year before any tax incentives. So you're overly reliant on your employment income here in this example. Now, if you can ride out that storm in a 20-year time frame, by 2045, you're still going to be cash flow negative. And again, yes, the argument is that tax incentives will bridge the gap, but you are still reliant on your employment income, and it isn't truly passive income. And 2045 here, you've got 1.3, and then 2045 here, you've got 630. So you're looking at roughly just under $2 million in equity in a 20-year period. But again, you're losing all this money in the meantime. So it's heavily reliant on your employment income. And that's predominantly why people get stuck at one, if not two properties. If you do have any questions, guys, please don't hesitate to reach out. I'd love to be able to go through more examples like this one of how to not build your property portfolio and what you do need to do to build a sustainable property portfolio. Please don't hesitate to get in touch. Thanks again for watching.